All right, this is the recording of Alison Brown, who is a financial educator and advisor, who is a guest speaker for our BA218 Personal Financial Planning class for fall 2025. Alison Brown, I've known for 8 years now
Wow.
in a couple of different capacities, um, as a bookkeeper and as a friend. And I gave horseback riding lessons to her daughters, and now as a financial educator. And so I wanted to bring her into the class as a different perspective. So you're not just hearing all this information from me. And one of the things Alison also does is insurance. And we haven't gone through completely our insurance unit yet. So you're going to hear some stuff from her that you'll also hear in my lecture. But all of it is relevant to all of you guys, regardless of if you're still in high school or if you guys have had some life and now you're coming back to school. So help me welcome Alison Brown.
Thank you so much, Ashley.
Yes.
I love teaching people about money. It is something that I am really passionate about, and I think that stems from just my life personally, because I don't know about a lot of you, but I'm really excited for you that you're actually taking this class in college because I never did. And in high school, I definitely never learned anything about money. And I wish if I could go back that I could have changed that because I think it would have made a really big impact on the choices that I had made going forward as a young adult. I did happen to get married really young. I was 21 when I got married. And so it would have even impacted the decisions that we made as a couple. And I wish, and I just didn't have the parents that taught me anything about money. Like they did the best they could. They were good parents, but they had their own issues, right? As so many of our parents do. And sometimes they don't teach us about money because they don't know anything either. So it's just a lot of figuring out on your own. But as Ashley said, like we've known each other for quite a while. I used to be a bookkeeper, so I thought that I would be a bookkeeper for a very long time. I had been doing it for about 10 years and I had started my own bookkeeping business and I loved helping small businesses and I was pretty good with math. And then I actually had a friend that was in Southern California. I live in Oregon, but he was in Southern California and he was posting on social media, excuse me, where he talked about like an event he was doing or something. And I was just like, I haven't talked to that friend in a while. And so I reached out. I said, "What are you doing?" And he shared with me the business that I'm now in, to where we get to educate people about finances and help them put things into plan for themselves. And it just really resonated with me. And I think it's because I was so desperately needing that information in my own life that it really just was like, wow, this is great. And I was able to make money doing it, actually help people and better my own life. And so it was just a great path for me. And so now I've been doing this for about 6 years, which is crazy how fast it goes. It feels like I just started, but here I am 6 years later helping a lot of people. We have a really big team in our area and across the country, and it's just awesome to be able to educate people about money because again, it's a big crisis. People just don't understand how money works. And when you don't understand how money works, a couple things happen. One, you get taken advantage of, right? You get taken advantage of in a way that it can really cost you years, if not, thousands of dollars, if not more. And you just don't get ahead as fast as the other guy, right? And so we want to change that today by giving you the opportunity to be educated about money. So I appreciate the opportunity. I've done this for a couple of Ashley's classes before, and the feedback is always typically really positive. So I hope that you get a very positive experience out of this. If you ever have any questions, Ashley's going to include my information when she sends out the video. So if you want to talk about money, finance, how it applies to you, I'd be happy to do that as well. I'm going to go ahead and share my screen. So this is a program that I offer just to educate people. It's through a program called How Money Works. I'm going to make my screen just a little bigger. Can you see that okay, Ashley? You want to give me a thumbs up? Okay, awesome. All right, so there is let's skip forward here. There's a thing that happens to us in life, and often we become kind of suckers about money. We get sucked into bad decisions. We get sucked into making poor choices or falling for something that feels safe, right? And here's the thing, like we need to think like the wealthy. And sometimes that can be a turnoff for people. People are like, oh, I hate the wealthy, I hate the rich. But here's the thing, they just got the help that they needed with money and they got somebody to teach them the things that they needed to know in order to grow their money. Have you ever walked into the bank and at the counter, they usually have a bowl of suckers, right? It's at my bank. I was there recently and I was like, I kind of snickered to myself. I was like, oh my gosh, that's crazy. But they had a bowl of suckers and they're usually the dum-dums, right? The bank is there to help you, yes, but they often take advantage of your ignorance. So let's change that today. Because Benjamin Franklin says that an investment in knowledge, it actually pays the best interest, right? And it is a strong word, right? Sucker is a strong word. But if you don't know how money works, what happens? Well, it sucks up your time. It sucks up your freedom because now you're either a slave to your job, you're a slave to that debt that you have to pay off, and it'll suck up your income, right? And so, like I said earlier, financial illiteracy is actually the number one economic crisis in the world because people don't know how money works. It really screws them up in the future, right? Now, I'm going to go through the majority of this presentation as time allows, but I might skip a couple things. So if you're like, hey, I wanted more information on that, again, just reach out. We can go over it on a one-on-one basis. But I want to make sure that we're covering things that are relevant to you today, and that are helpful for you in your just knowledge about money and finance. So just be aware of that. All right, so actually, a recent study on financial literacy found that only 30% of the people in the world are financially literate. What does that mean? Well, it translates into things like this, where like 44% of Americans, almost half, can't cover a $400 emergency. Is that you? That's one of those things you have to really think about. Like, oh, if I needed new tires on my car, where would that money come from? Right? If I had a medical bill that I had to pay, where would that money come from? You know, we have to think about that. And right now, most Americans can't cover that. And a lot of people that are borrowing money for student loans, they're not making payments. They're deferring that. And here's the thing, those bills, they don't just sit there and wait for you to pay them. They actually get bigger, those loans. So be aware of that. And then, the average credit card debt is about $10,000, just under $10,000, right? Which will pay out a lot of interest. And then 33% of American adults have zero retirement savings or very little. I literally had a client in my office last night. We were talking about her retirement, and she's in her late 50s, and I'm not sure how she'll retire one day. She just doesn't have, she barely has anything. And that's a normal because they don't understand how money works. They don't take time to make changes. And so we need to change that. All right. So, and the other thing is like, our high schools aren't teaching people about money. So, like I said earlier, I never learned anything about money in high school. I literally think they taught us how to write a check and maybe balance a checkbook because of like a course we were doing. But I don't even write checks anymore. I think I write maybe two a year because it's just not a standard. We all pay online or we pay with our debit cards, right? There's paperless transactions now. It's not actually helpful. They are starting to change this. We're seeing more and more where high schools are actually starting to implement financial courses in high school, which is amazing. But we still need to continue our education beyond that because, to be honest, like, how many of us really remember all the things we learned in high school? Maybe if you're really like right out of high school, maybe you still do. But as somebody that's a few years out of high school, just a few, I it's not very relevant to me today, and so much has changed too. And the lack of financial literacy, it really traps you in what we call the sucker cycle, right? When you don't understand how money works, here's what happens. You tend to spend money on things that don't matter. You have subscriptions that zap your account, or you're going out to eat all the time, or you're spending money on, ride shares. I was just thinking about like DoorDash, right? How many of you are door dashing? I know we're all probably a little guilty of it, but door dashing is like the biggest ripoff ever. Sure, it's super convenient, but you're paying typically more than double um, what you are uh, what you are, able to pay just in the restaurant, right? It's ridiculous. It's crazy. So just think about that. Like, how am I actually spending my money? Um, let's see. So one of the big problems is that no generation is actually saving enough, right? when you think about how much money you want to make in your career. Now, I know a lot of you you're going to college maybe to improve your career, get a new degree. When you think about how much money that career will pay you, let's just say for round number sake that you need to you're going to make about $100,000. Let's just say that's your goal income, and that you're getting about $80,000 a year to live off of in retirement. So if you think about it, you've got, if you're like fresh out of high school, maybe you've got 30, 40 years of working years to save up so that in the last 20 to 30 years of your life, you're going to have that same kind of income, right? And Social Security is supposed to cover about 40% of what you brought home, right, as a working individual. But guess what? Social Security is not a guarantee. I hate to say it. When Social Security was started, it was about 40 individuals that were paying into the program for every one individual that was drawing a Social Security check. Now it's about 1 to 2 individuals for every one person that is drawing out a Social Security check. You can kind of see how that's not going to work, and it's actually it's not going to last. I don't know how if it's going to go away completely, but they have said that like 20, I think it's 2037, we're basically not going to have a Social Security trust fund anymore. Like it's there won't be enough money to sustain it, right? So what does that mean for you and I? Well, especially for you, it's not a guarantee. And unless something dramatic changes in our government and in the way that they do stuff, you can't count on it, right? Um, and right now, the average Americans that are aged 60 to almost 70, they only have $200,000 in their retirement accounts. And I can tell you from working with these clients, it doesn't go that far, right? It's not enough. So you just want to think about that and kind of where you're going to head. Now, can we change that? Right? We're thinking about like kind of retirement, and maybe we're going to skip over a little bit of this because you're not there yet. But the point is here is you have to think about like as you're saving, you're building towards a future where you don't have to worry about money. But if you don't save and you put it off forever, that future eventually comes and smacks you in the face, and you're like, wait a second. I'm not going to have anything. Yeah, Ashley, you had a question?
Oh, I was just gonna say you don't need to skip over retirement stuff. We did a whole unit on retirement and
Oh,
how
excellent.
savings is a requirement. We even talked about what age people want to retire
Oh, beautiful.
based
Yes.
on that. So,
Excellent. Okay, so you guys are experts already. I love to hear it. All right, so but you have to think about like, are you going to have enough in your personal savings to actually, cover retirement, right? And Social Security is not going to be there. So it's basically all you. Now, I don't know if you guys know what a pension is. Maybe you talked a little bit about that, but it's a rarity to have a pension anymore. If you work for the state government, typically they do still offer a pension program. So, like firefighting, police, state jobs, teachers, those all right now, as far as I'm aware, in most states, all have a standard pension. And a pension is basically where it is you've paid into it, and then that company or the government will pay you a retirement payment once you hit retirement for the rest of your life, right? Now, like I said, those are not as typical. It used to be pretty standard that most companies offered a pension. Like my grandfather, he retired at the age of 55. He had Social Security. He had a pension from the company he worked for, which was the Bell Telephone Company, which no longer exists. And then he had personal savings. So he had three things that allowed him to retire and retire comfortably early, and it lasted his whole life. He lived till he was just shy of 96. And he was retired for 40 years and never ran out of money, right? Because he made good decisions. He was frugal. He saved, those kind of things. But a lot of those things are going away. Social Security, we can't count on. Pensions can't count on. So it's just your personal savings. Okay. So you want to think about having a reliable income into retirement, right? Does that mean you have to start saving $1,000 a month now? No, it doesn't. It really depends on your own situation, but you have to start saving and letting compounding growth work in your favor. Okay. Now, compound interest, it's one of the best things out there if you understand it. Now, it can work for you or against you, so be aware of that. And way compound interest works, which you guys should probably all know because you've been in Ashley's class, is that it's earning interest on interest, right? So just like she says there, this is all based on a book that has great cartoons. If you guys want the book, let me know. Or just email me. Um, but it's just a really simple thing that can change your life for good or for worse, right? So simple interest, as you may know, you only receive interest on the principal amount every single year. So if you have $1,000 and 10% interest, every year you're only getting $100 of interest. Never more than that. Never less, but never more. Okay. Compound interest is where, again, you have that $1,000. Year one, you earn $100, but year two, you earn $110 because it's based off of compounding growth. So earning interest on interest, right? Makes a really big difference when it comes to savings. So if you had a simple interest account where they were paying you just 9% on $1,500, this is the example, then by the time you are the age of 50, from like 0 to 50, you would have $8,250 with a simple interest. It's all right. Not great. It's not great at all, actually. But we have compound interest. That same $1,500 with a 9% annual interest rate, no additional funds added to it over a 50-year period becomes $132,000, right? So if you have $1,500 in an account, it's getting 9% compounding interest, and you just let it go for 50 years, you're going to have $130,000. Not too shabby for not doing anything else, right? But that's the difference for compound interest and simple interest. Sorry, I'm like dying today. All right. So if you look at the following like growth curves, they look at when we're adding month to month compounding. It makes a really big difference. I'm so sorry. Goodness. Um, so if you do $178 a month, so I don't know how old you guys are. I know some are coming back to school, some are probably right out of high school, maybe some are just in the middle of life here. But let's just say you start at the age of 25 and you put $178 into an account. Why did they pick that number? Probably so they can show you the $1,000,000 at the end here. But $178 a month from age 25 to 100 to age 67, depending on the interest rate, will reflect change how much you're earning and you get, right? $178 at a 1% interest rate will get you about 111,000 over those, 35 years or so, 37 years. It's all right. It's not great. Now, most bank accounts, they don't even offer you 1% when it comes to savings. So if you're stuffing all of your money in a savings account because you're afraid of the market or you don't want to lose your money or you just don't know what to do, we need to talk because that's just not going to get you growth. You need to keep an emergency fund in a savings account, but your long-term investments should not be sitting there. If you could get 6%, that's the orange, you'd have a $400,000 balance by the time you hit age 67, so a little bit better. If you could get a 9% rate of return, which to be honest, if you're investing in the market and you have it in kind of a mix, you're not just doing high risk or really conservative, you should be able to get at least 9% over the time of your investment. You would have $1,000,000 by the time you're 67. Right? So what do you want? Do you want 100,000 or you want $1,000,000? I definitely want 1,000,000 because I like spending money and like having fun. So I mean, I want more money to go and live that life, right? So you want to think about where you're putting your money because it's really important. Now, the thing with money is so many of us get in our heads and we get stressed. I don't know what to do. I don't know where to start, right? Well, I wish I would have started 10 years ago because I would have been further ahead. There's 3 action steps that you can take that are really simple and they're not complicated. So start now. Just open up an account and start investing, right? Like I can help you with that, or you can do it on your own, whatever. But you start now. You open up an account. You start consistently saving. You save regularly. One of the best ways to save, in my opinion, is on autopilot. Just so it happens, you make it automatic. It automatically comes out. You don't have to think about it because if you're always having to go and make the transfer or move the money, well, some months it'll happen and some months it won't, right? And so if it's consistent and on autopilot, that's good. And then be patient. Don't just dip in there all the time, right? Just don't go back and forth and dip in there and take your money out. So I love this example. This is an example of 2 individuals that started at different times and how it affected their future. So Sarah here was 22. She got her first job right out of college. And she's like, you know what? I am just going to start saving a lot of money because I have a great job. Right. So she saved $4,000 a year. She worked until she was 30. And then she's like, you know what? I'm going to go start my own business. And for whatever reason, Sarah just did not keep saving. She just forgot about that 401k. She just let it go. Maybe she invested somewhere else, but she just let it sit. She didn't even think about it. Right. And it continued to earn interest. Now, George came on at the age of 30 and finally got a job where they had a 401k. And so he finally started saving money and he put away the same amount that Sarah did every year, $4,000 a year for 38 years. Sarah, remember, she only did it for 8 years. George saved for 38 years and didn't stop until he was 67. George has less money because Sarah has the thing with time. Time makes such a difference. So if you start now, even if it's not as much or even if it's not for as long, right? You still can have more money because you've have that time value of money. And the reason that's important is I'll go over that in a second, but does that make you want to start now? I really hope it does because I personally like I wish I was Sarah. Right? I wish I would have been smarter and like started earlier. Like I said, I wish I would have known these things earlier on in my life. Because the longer you wait, the more you must save, right? So if you are age 20, congratulations. You are in a perfect spot in life to not have to save a lot and still have great results, right? So if you're investing like $113 a month, by the time you're 67, and if you never increase that, you would have $1 million, right, in savings and investments. Is that enough to retire on? I don't know. And I don't know that it will be. But if you take that and multiply that, let's say you want $3 million saved and invested by the time you're 67. Okay, we'll triple that number, right? But let's say you're 30 and you're like, shoot, I got a late start. Okay, $282 a month. You can do it, right? But if you're 45 or you're 50 and you're like, oh, I'm so behind, these are the numbers, right? That's why the time value of money is so important. So we can moan the fact that maybe we got a little late start or we're not where we want to be. But if you just get started, it's better than waiting another year or two, right? So even if you're a college student, you don't have a lot extra, even if you could save $100 a month, figure out how to get $100 a month and start saving and investing that for your future. It's so important, so critical. All right, I am going to skip over this concept. It's called $1 million baby. If you have children, or if you're wondering, like myself, why my parents did not do this for me, let me know. I'll talk to you about it. But basically, it's the idea of creating a legacy for your children so that they can have $1 million, right? By the time they hit retirement from you, like as a legacy to them to get started, right? So it's a really cool option here. I'm just going to skip forward, but we're going to talk actually about the rule of 72. Okay. So the rule of 72 is like money math magic, right? It really helps you understand um, compound interest. When I think about compound interest before I kind of started teaching this, right over my head, I was like, well, I know my investments grow, but I don't really understand what they're doing. I know they go up and they go down, right? But I don't really know. I don't get it. So the rule of 72 is something that you can use to kind of understand what your money is doing, right? So if you take 72 and you divide it by your compounding interest rate, it tells you approximately in years how much time it takes for your money to double, right? So if you have a 1% rate of return, your money will double in 72 years because 72 divided by 1 is 72, right? Pretty simple, pretty straightforward. So how does this apply to you and how do you think about it, with your own accounts and things like that? So if you have a 1% rate of return, it takes 72 years to double. If you have a 3%, it takes 24 years to double, right? 72 divided by 3 is 24. 6% is 12 years, 9% is 8 years, and 12% is 6 years, right? So why is this important? Well, if you have your money in an account and it's not earning a lot of interest, your money is not going to grow very fast, right? So if you open up your bank app, if you like while you're watching this at home, open up your banking app on your phone, go to your savings account and look at the interest rate that they are giving you in your savings account. My bank, I have a credit union and they have different kinds of savings accounts, but their regular one offers a whopping 0.01% interest. 0.01, not 1, 0.01. So if you take 72 and you divide it by 0.01, The money in that account would double in 7,200 years. Do you remember how we talked about like being a dum dum at the bank? Like, come on, like that is literally what they do. They don't educate you on what your options are. They don't give it. And so many people just leave their money, trillions of dollars, are just sitting inside accounts that earn less than 1% in interest. It's crazy, right? But it's because people aren't educated, they don't pay attention, and they just don't know what to do, right? And that's a big problem, is that you're just letting your money sit there, right? Even an emergency fund should have some interest growth on it, right? You shouldn't just be letting it sit there at an interest rate so low it doesn't even do anything, right? Now, this is just that same example, right? Let's just say they gave you 0.15%. 72 divided by 0.15 is 480 years to double. Basically, that example means that a dollar would not become $2 until the year 2504 with a 0.15% interest rate. Crazy. It's just crazy. So here's the thing though, if you think about it. So the average new credit card interest rate is now 22%, which is 22.44%. So if you do the math on that, 72 divided by 22.44%, now your credit card balance is going to double every 3 years. So if you're not paying it off every month or making really good strides to pay it off, you're just paying the minimum payment, you see how they get you, right? The bank will often offer you, oh, here, come put your money in our savings account. We're going to give you 0.01% interest. Guess what? Would you like a credit card? It seems like maybe you need a credit card, and you can borrow money from us, and we're going to charge you 22.44% interest. Who's making money? It's not you, right? So you got to be smarter than the bank. You got to think about what you're doing. You got to think about where you're putting your money. Now, this is something that I go over with all of my clients. There's basically 7 money milestones when you think about like where we're at and like your journey with money. Like you want to understand like where you're at on that journey, what comes next, what do you need to be taking care of, right? And so we'll just kind of skim over all of these as kind of as time allows. I want to just touch on each one of them. So the 7 money milestones are basically this. We start with financial education, having proper protection, having an emergency fund, taking care of debt if you have it, thinking about your cash flow and how to make money, building wealth for the future, and then also protecting your wealth, right? So those are kind of the things that you need to think about all along the way. Now, we start with financial education. So, number one, taking this class, huge. Congratulations. Good job. You are further ahead than most Americans by understanding how money works, right? Um, and really just figuring out like what you need to know. So, number one, there's 2 things that I would recommend. So, one, educating yourself. Um, Again, there's a book that goes along with this presentation, but that's a really good start. There's a ton of books out there, a ton. There's so much information. It can be overwhelming, but there's so much out there in resources. And so if you're not educating yourself, it's kind of your fault. I hate to say that, but there is no excuse in this day and age for you not to be able to figure out like where can I learn? There's YouTube channels, there's books that have been written. I do always recommend you check your sources and make sure that people are legitimate in what they say and they have the history and the reputation to prove it, right? And why you should listen to them. One of my favorite books to understand money is Rich Dad Poor Dad. I think that's a really good one. Yeah, Ashley?
Yeah, I provide the class with a whole list of vetted financial education books, including the one you're working off of, including Rich Dad Poor Dad. So if you guys need that list again, email me and I will resend it out.
Yeah. So, I mean, there's just no excuse for you not to take advantage. Like, in my opinion, you should try to read a couple new nonfiction books every year to learn and educate yourself. Like I try to push myself to read one a month, right? Because I want to learn and grow, and that's where I'm at in my journey. But if you could read a couple a year, maybe listen to podcasts, like really get some good information, it's out there and available for you, right? Number 2, work with somebody like myself that's a financial professional. Work with a guide. I personally believe that finances should not just be DIY. Every once in a while, every couple of years at least, you should check in with a financial professional, hopefully one that you can have a good relationship with, and say, hey, are we on track? Am I doing what I need to do? Where can I tweak? Where can I make a change, right? So just having somebody like myself that can work with you, that can help you to make good and educated decisions, I think that's really important. Now, let's talk about proper protection. So, proper protection is really crucial. And the reason that we put it at the beginning, because it's a foundational piece of any financial plan. It's truly foundational. And when we're talking about proper protection, we're talking about life insurance. And some of you might be like, that's dumb. I don't understand. Life insurance literally protects your assets, it protects your family, it protects you. And so when you think about how much life insurance that you need, it really depends on where you're at in your life, right? Like it depends on, um, how much money you're bringing in, if you're married, if you have kids. My personal belief, though, is no matter if you have kids, are married, and all that, if you are an adult, you need life insurance. It doesn't have to be an excessive amount. If you don't have a huge, what we call insurable need, you don't have to have $1 million policy. But every adult should have some life insurance. Now, when I sit down with a couple and they have kids and they have a house, we usually use this formula. So 10 times your annual income, right? So if somebody's making $80,000 a year, then they need about $800,000 in insurance. Or if they earn $50,000, it's $500,000 in life insurance. $100,000 would be $1 million of coverage. Now, often people are like, okay, well, I also have debt and I also have 10 kids. Well, I don't know if you have 10 kids, but I have met with families that have a lot of kids. Or maybe, health is a consideration. Like, I feel like I'm healthy now, but I don't know, I've got some family stuff, so I'm not sure if I will be in the future. Sometimes we even use life insurance in a business situation, right? Or how old you are. So everyone's situation is different. And so we look at all those factors when we think about like, what do you need, right? Most people think that they don't need more life insurance than they have. They underestimate how much life insurance they actually need. And they have a tendency to think it's too expensive to get the amount that they need, or they overestimate how much it's actually going to cost. So about 60% or so of Americans actually have life insurance, and about half of the people that have it are underinsured. Now, if you have life insurance at a job, it's not like it's life insurance, but it's a bonus. Don't count that as your only policy, right? You need to have life insurance that you own because as soon as you leave that job, like most people switch jobs multiple times throughout their career, they don't stay for long term at jobs anymore. So as soon as you leave that job, that doesn't follow you. That employer has the ability to terminate that policy at any time and not get your approval or permission to do so. Um, that life insurance policy will not follow you once you retire either. So it's just not something that I would count on. If you have it, great, it's a bonus, but don't consider it your only policy. Um, so there's two types of different life insurance, right? We have temporary and permanent. Now, if you're young, if you have, a lot of things to cover, like a home or a family, and your budget is low, term might be the right fit for you because term is temporary. So term insurance means that it covers your needs for a specific period of time, like 10 years, 20 years, 30 years, right? Something like that. There's a few in betweens too. But so for example, I have a policy on my husband that, over the next 20 years or so, it would cover us if he passed away because I still have a mortgage, right? We still have a mortgage and we have kids at home. So I wanted to make sure that he would have some extra coverage. It's a lot cheaper than if I got him a permanent policy, but it fits for what we need right now. That while we have a mortgage, if something happens to him, it'll pay off the mortgage and then some, right? It'll give me some peace of mind. But after 20 years, that policy ends and I will not continue to have it because it's no longer at that same price, right? You get it for a term, a period of time. And it's the most affordable version of life insurance because it doesn't last forever, right? It's for a set amount of time. So it's great if you have a mortgage, you have kids, you have a spouse, and you need a lot of coverage for a little bit amount of money. You just need to make sure just in case something happens. If you guys were all here in class with me today, I'd say, how many of you have seen a GoFundMe on Facebook? So and so died. Please help their family. It's because they didn't have any life insurance. Don't be that person. Don't make your friends and family go put up a GoFundMe because you didn't take care of it, right? Now, with term life insurance, like I said, it's possible to get a substantial amount of life insurance for your family or business with a relatively small monthly payment. So maybe while you're raising children, like I said, or you're still paying for college, right? If you are going into debt for your tuition and, and sometimes, yes, student loans aren't paid, don't have to be paid off after somebody dies, but there's other situations where maybe you're using other forms to pay for college. Don't leave them unprotected, right? Get a little bit of life insurance to cover whatever costs you might leave behind. And then, if you're running a company, right? Like if you're starting a business and you want to make sure that you're protecting your business partners, if something happens to you, term life insurance could fill that. Yeah.
Yeah, I can't remember if I said this in the lectures that you guys have listened to, but my first term life insurance policy I got when I was 22 because my grandma co-signed on my student loans. And I wanted to make sure that if something happened to me, I got hit and killed in a car accident, whatever, that she wouldn't be responsible for my student loans. And I paid $10 a month for $125,000 in coverage that would cover my student loans and funeral expenses.
Yep. And that's the smart thing to do, right? It's just like if somebody else is taking on a burden for you or has a responsibility, if you are not around, it is appropriate to have term insurance, right? Now, sometimes we get to the point when the term ends. So, like I said, my husband has coverage for a set amount of time, and there's going to be a point where maybe I don't need life insurance on him. Maybe we are financially set, my home is paid off, our retirement accounts are full. If he passed away, it would be sad, but it wouldn't necessarily change my financial situation. But there's also that other scenario where, I would still be greatly affected if he passed away financially. And I would still need term life insurance, right? Or I still need life insurance. Well, what do? Well, there's this thing called a financial X-wave, right? And so if you can follow it here, on the top left, it says more responsibility, and then in life, you get less responsibility. Believe it or not, my kids are starting to move out. Like I have two college students, right? And I have a high schooler. My responsibility is lessening in the amount of children that I have to be responsible for, and I'm working on building more wealth into my life. So I don't necessarily need a ton of life insurance, once all the kids move out and things like that. But I'm still going to want some life insurance. And that's when permanent life insurance can kick in, right? And the earlier you start it, the less expensive it is, I'll tell you that. But it can cover like a long period of time, right? So it provides a death benefit to protect your family financially, but it's also designed to be kept for life, not just a period of time, right? And so you got to think about what you need it for. It could be for long-term care. It has a tax-free death benefit. You can actually create supplemental tax-free retirement income with a permanent policy. It's a lifelong strategy that can protect your family today, and secure your future for tomorrow. Okay. And there's different benefits to life insurance, that it's permanent. You can have life insurance coverage for life. Long-term care is optional rider. And you can also have some cash value built into it that offers some flexibility, right? And so that money that you put into a permanent policy, it does a couple things. So it pays for the life insurance policy. And then there's also a portion that goes into an account that grows, right? And so you can use it for cars, vacations, weddings. You can start taking money out at retirement and create some retirement supplemental income, right? So, and it can grow tax free, and the creditors can't go after it, which is pretty cool. And there's no market risk for when you have your money in there, so you don't have risk like you do in the market. And again, pulling that out tax free as income, right? So there's some cool options that you can use with a permanent policy if you know how to use it. And then also long-term care. Long-term care is something that we think about, right? Every state, not every state, but a lot of states are starting to require that you actually have your own long-term care policy. Washington implemented about 2 or 3 years ago that every individual either has to purchase their own personal long-term care policy, have one through their employer, or they have to pay for the state. Because the state's like, we're tired of paying out of pocket for people that didn't prepare. It's now mandated that you have to have one, right? So it's something that's becoming a conversation, and we could see other states follow suit, right? I'm not going to go over a ton of this because I just want to get through some other things, but long term care is just definitely something I would say typically between the ages of 40 and 50, you really want to make sure that you have one of these in place. It's a great idea to like just protect your family and protect your assets, right? So let's talk about some other critical things. So an emergency fund. An emergency fund is one of the reasons that people stay out of debt or they get into debt. um, if you have an emergency fund, if you can cover 3 to 6 months of your expenses, then if something comes along your way that throws a curveball, then you could use your emergency fund and pay for it, right? So if you think about how much income you're going to make, now I know as college students, you might be working already, going, school part-time. Maybe your income is $50,000 a year. 3 months of that income is about 12,500, where all 6 months is about 25,000. Remember that having an emergency fund, that emergency fund is specifically for emergencies. It's not for the Taylor Swift concert tickets that we know are not coming anymore, but or whatever concert you love, right? Or that trip that you want to take with your friends to Europe. That's not what emergency fund is for. It's truly for emergencies. So a broken car, fridge, or whatever. That's what the money's for. If that happens, spend the money, right? How do you save this much money? Allison, I love this idea. It's great, but like I don't have $12,000, right? I spend my money every month. We pay our bills. Well, couple things. You got to probably start looking at where you're spending your money. Maybe you need to sell some things. Maybe you need to take a little side hustle on. If you're really like paycheck to paycheck, think about how to increase that income and start being consistent with saving. So again, it's that automated savings, maybe $100 a month, maybe 250. When you get your tax return, instead of booking the vacation, put it in savings until you have a fully funded emergency fund. That needs to be your number one focus. That's my personal opinion. Because when you don't have an emergency fund and an emergency happens, you turn to a credit card or you have to borrow, right? And you just get yourself in a really tough spot. And that leads to debt, right? So when we talk about debt, we've got to start thinking about our spending habits, right? So often people ignore things in their finances. They just don't pay attention. And the average American actually has about $29,000 in personal debt, right? That includes credit cards, student loans, personal loans, cars, things like that, right? There's 5 tips that they give here that I think are really good to eliminate and stay out of debt. So one, know what you owe. Don't put your head in the sand and be an ostrich, right? Know what's going on with your money. Number 2, automate your payments if you can. No more late payments. That will ding your credit. It's awful, right? If you can just be on time, that's huge. Just be on time with your payments. And when we're paying stuff off, we want to target one debt at a time. Don't just take all your extra money and throw it at a few, like all the debts. If you have, let's just say 3 credit cards, take the extra money and make your minimum payments and then throw the extra money onto one of the credit cards and do that every month until that credit card is paid off, and then take that extra and the regular minimum payment for that credit card and pay off the next one, and do that until that one's paid off, and then take that and those 2 minimum payments and apply it to the last one, and then eventually that's going to be paid off really fast. It just makes it go a lot quicker. Every once in a while, though, you guys, you've got to go through your statements. I would say every month, every other month, once a quarter at minimum, go through and start canceling things. We sign up for stuff all the time that we forget about. You need to go in there and like cancel those unused subscriptions, right? If you're not watching Netflix because you're busy doing schoolwork, good for you, then cancel it, right? You can bring it back in. And if it's a distraction, right? If that Netflix account is a distraction to getting things done that you know you need to be done, cancel it, right? Save yourself the $20 a month or whatever ridiculous amount they charge now. Um, you know, Save that, right? And if you have a home, right, and you have a higher and you want a mortgage rate, refinance your home, get that payment lower, right? It might not always be appropriate, so maybe think about that one, but that's an option. You can also use the equity in your home to pay off debt, I think was the point there if you needed to. But also be cautious about that because it's a bad cycle if you don't get to the root of the problem, which is overspending, right? Let's talk about increasing cash flow, right? So you might need to earn additional income. And but let's start with the basics. So we want to create and stick to a budget. One of the things that people avoid doing, I think, is a budget and paying attention to their money. When you have a budget, you can really look at like, what am I bringing in? What am I spending? And when I am spending, is it a need or a want, right? And how am I using my money? When we're good, there's this phrase called being a steward. When you're a good steward of what you have, like taking care of what you have, and generally that allows you to bring in more, right? When we're wasteful and we're not taking care of what we have, then we don't typically, get to bring in more. Have a written game plan for your money. Focus on spending less than you earned. It's an old concept, but it works. Live a more modest life, right? We don't need big fancy things, right? Maybe that's a goal for when you hit your $1 million in income, but until you hit your $1 million in annual income, we don't need the fanciest car in the lot, right? Check your home and auto insurance rates. So many people will just keep it with the same agent. So I don't know if you guys know this, but like when you have home and auto insurance, you have an agent that's assigned to you. Um, Often, sometimes I think they're moving away from that a little bit, but typically you have an agent that's assigned to you. I know a lot of people that will stick with the same policy, even though the premiums have gotten more expensive because they like their agent. You really should be shopping about every 18 months to 2 years for new home and auto insurance, right? And again, look at where your money is earning money. So if your savings is all is in that 0.01% account, we need to find some different accounts to put our money in, right? And if you have a home, the moment you have at least 20% equity in your home, you can have your mortgage company drop your private mortgage insurance, which is like a couple $100 a month usually, right? So that's a way for you to save some money. So add a side gig, right? Let's just say that you're not making enough and every month is tight. Well, you know what? Get off your butt. I'm sorry, and go do something. That's really mean. I shouldn't say that, but get off your butt and like find something extra. Maybe start a little business. Maybe go do DoorDash. Again, don't be the one buying DoorDash, but maybe help others spend their money and make some money. Do Instacart, just something. Do some childcare on the side. If you're really struggling, you are a capable human being. Go out there and do something. Like I said, you could start a business, right? One of the ways that I started this business is I did it very part time alongside my other responsibilities. And eventually it became my full time, right? But I started very part time. You can do that in many businesses. You don't have to go full time into a business to make extra money. And sometimes, if you are getting a giant tax return consistently every year, you're probably giving the IRS too much money during the year, right? Basically, if you get a giant tax return at the end of every year because your withholdings are so high, it's like you're giving the IRS a 0% loan on your money and they're just returning it at the end of the tax year. Don't do that. Keep your money for yourself, right? So talk to a tax advisor. I'm not a tax person, but if you end up always getting a return, kind of figure out why. And if it's because of your withholdings, then maybe you want to adjust that so more goes back into your pocket every month. And then building wealth, right? So we just got a couple more minutes. I don't want to take too much more time on these last two, but I think they are really critical. So once we kind of have our money under control, we have an emergency fund, our debt is either managed or being paid off, right? And we're bringing in a good income, we want to build wealth. And we talked about the time value of money earlier. It's really important that you don't put this off forever, right? That you keep consistently saving for yourself. Um, Here's the thing, will your wealth last as long as you do? It's a question you must be able to answer. It's really true. Like if you get to retirement, you're like, I have nothing saved. That's a problem, right? If you can confidently go into retirement, go, yeah, no, we've got like this account, we got our 401k, we have our Roth, we have this, that, whatever, and you know that you've put together a strategy, how much better are you going to feel going into retirement and be confident that you don't have to go back to Walmart to get a job as an 80-year-old greeter because you run out of money, right? 63% of people actually have a greater fear of running out of money in retirement than dying. So maybe this isn't you, but maybe it is a conversation that you should have with your parents, right? Like if you're in your 20s, like, hey, mom and dad, have you guys been saving for retirement? Like, what's your situation? What are the things that you have done that have worked, right? Like, have those conversations with those people in your life that are successful with money. Now, if you have a broke Uncle Joe that's always giving out his advice, we don't recommend listening to him. That's just not a good idea. But talk to the people that have had success in their life with saving and investing. What are you doing? What is working? How did you start saving for retirement? Right? And get their their input on that. Now, there's four things you have to think about when you're thinking about building wealth. You putting off, building the wealth is one of the threats that you have to think about. Procrastination. You have to think about losses, right? Inflation, right? Because everything gets more expensive. If you haven't noticed, everything in life is more expensive now. COVID like ramped everything up. So traditionally, or not traditionally, on average, we typically have about a 3% inflation rate. It's pretty standard. If you look historically, it's 3%. Between, I think it was 2020 and like 2023 or something, it was like 7 or 8%. It's crazy. That's a lot of growth in the cost of goods, right? Did you want to add something, Ashley? You're unmuted, so we can't hear what you want to say, but you're muted.
Sorry. I just realized I was still on mute. 2020 was 1%, 2022 was 7.1%, 2023 was 7.5%,
Yeah.
and last year was the first year we came back down to historical normals, which was still 3.5%.
Yeah. So, like I said, you have to like factor that in when planning. The same dollar that you can spend today by the time you get to retirement will not cover the same amount of stuff. Like everyone always complains about the baby boomers because they ruined everything. I don't think that's true. It's just that was their generation, right? And um but they, like my dad, he bought his first house in Portland, Oregon, and it wasn't a fancy house, but he bought his first house on like an acre in Portland, like the city of Portland. I think they paid like $30,000. And now that particular property I think is worth like 800,000. We don't live there anymore, but like that is inflation. That's why like what you have today is not going to cover tomorrow. So you have to think about that. That's why you can't just save in the bank. You actually have to outpace inflation with your investments, right? And the other thing you have to think about is taxes. So the impact of inflation, like I just said, we got to think about it when we're thinking about investing in our money. And I'm running out of time, so I just want to kind of go over these really quick. So, rule of 72, think about it. Like if the average rate of inflation is 2.8%, right? That means every 25 years, the cost of something doubles. So, if in 25 years, let's say you have a home and today it is $500,000, just for number's sake, in 25 years, using inflation, it's going to be worth $1 million just with inflation, right? So you got to think about that. Losses, right? We have to think about losses. So did you know that if you lose 50% of your investment, you don't have to gain back another 50%? You actually have to gain back another 100%, right? So think about kind of the risks that you're taking with your money. And you got to think about taxes. If you put everything in a tax deferred account today, you're going to owe it all, like a good chunk of it, to the government when you get to retirement. So you got to think about when you're doing a tax strategy, where are you putting your money and how much you're going to be able to keep for yourself, pay to the government, and pass on to your children one day. There's three different types of tax accounts. There's accounts that are taxed now. You're paid on your tax on interest, earnings, and dividends every single year, typically at a capital gains rate, which is usually 20%. Then there's the tax later. That's going to be a 401k, an IRA. There's different ones like pensions, 403bs, things like that. You're not paying taxes now. You will later in retirement. And then there's a tax never, right? Or a tax-free type growth, right? And that's where you're paying taxes on the income that's or the money that's already been put into that account, but all of the growth is tax-free. So that's a Roth IRA, cash value life insurance. Those are tools that we can use to grow tax-free savings for retirement. And I just got to think about the risks, right? Like, where are you putting your money? Like, are you more conservative? Are you taking bigger risks? What kind of losses can you face? And then finally, this is something that I think every adult, again, life insurance is something every adult needs. And then every adult also needs, at the very least, a basic will and an estate plan. So, if you guys know who Prince is, Purple Rain, that's a very popular song. Um, his estate was valued at over $150 million. Aretha Franklin, if you don't know who she is, you need to go look that woman up because she is the queen of soul, right? Like she's amazing. But she died in 2018, had an estate of 80 million, and neither of them had an estate plan. What happens when you don't have an estate plan? You go through this lovely little thing we call probate. It costs a lot of money. It's a nightmare to get through. But by having an estate plan, your wishes can be carried out. And what is an estate plan? It's having a will and or a trust, right? And then there's important documents that go along with that to protect yourself and your loved ones. So you'd have a will, a financial power of attorney, an advanced healthcare directive or living will, and then a HIPAA form, right? So those are things that you need to have within your estate plan. And again, like I talked about probate. So, and trusts are something that you might want to look into as you acquire assets or when you have children or things like that. It's a really more higher level way of protecting your estate. So, that is all I have for you today. I know it's a lot. We covered a lot. Again, if you have questions, Ashley has my contact info. You can reach out and we can do a customized financial plan for yourself if you want more information on any of those things. That's what I'm here for. But I hope at the very least you learned something today and you're able to take something that you can apply to your own situation. So thank you so much for having me.
Thanks, Allison. That was a ton of great information. If someone wanted to reach out to you, I'll get your contact information posted for them. How much would it cost them to work with you?
$0. I do not charge to put together financial strategies. All of my services are complimentary. And so you never have to worry about paying to meet with me.
Okay. And I just like to throw that out there because a lot of us, especially in our 20s, are that's one more thing that we're going, okay, well, like I can't afford that. So having someone who you can meet with that doesn't cost you anything extra, but gives you more insight beyond the budgets and the units that we have done together in class, um, just adds another layer to what Allison was talking about with your financial, consistently financial, giving yourself financial education
Yes.
throughout your life. So
Yep.
thank you so much for joining us, Allison. I appreciate your knowledge and you giving us your time.
Of course, you're welcome.